Hello traders and welcome to a new video on a platform I have never covered before called CoinCall. Speaking of covered, we're going to be covering two different types of option strategies today, which I've both done and I both really like. Covered calls and a PMCC, also known as a poor man's covered call. Let's dive in. So, first of all, what I like about CoinCall, again, I have never talked to these guys. This is not paid in any way. I'll be posting a referral link for this exchange, but because I haven't talked to the team, this is all at your own risk, of course, because I don't have a connection with the team as of yet. So just want to let you know that. Okay, so a covered call, this is probably one of the best, if not the best exchange to do this on for a lot of reasons. One, they allow a lot of different options, as you can see right here. So what you can do on this site, which you can't always do on other sites, is they allow something called multi-currency margin. Now, if you're very familiar with options, this video will probably be pretty good for you. If you're not too familiar with options, do your best to try to get through this and then learn some more after. So multi-currency margin, what that essentially means is that you can use anything under the sun to margin any options or futures position, which is amazing. That basically means that you can create all different kinds of positions and have them safely margined so you can't really be liquidated, or you at least reduce the risk of your liquidation happening. So here's one thing that I wanted to show you guys. So what I did was I bought Ripple, I bought XRP, I bought 97 of them. Now what I'm going to be doing is I'm going to be running a covered call strategy. What a covered call strategy is just selling the same amount of a call that I own in spot. So if I own 97 XRP, I also need to sell 97 calls worth of XRP. That's how a covered call strategy works. So if I do that, you're going to see that I actually, again, as you can see from my assets, I only have 35 cents in equity and Tether, but I have 97 in XRP. But if you look here, if I try to go to, like, let's say, I look at XRP and I say, I think that we're actually just not going to be above 54 in 6 days, which I think is, I don't know if I agree with that, but let's do 54. So if I think 54 is a good strike price, what I can do is I can sell at this bid price of 0.002, right there. So how much can I sell? Well, I can sell up to 600 XRP, which is great. And that's actually, what that's actually doing, guys, is that's using my XRP long position as margin for a very large short XRP position. However, I don't think that's really safe, and that's not an actual covered call, because a proper covered call uses the same amount of XRP, or the asset that is long, that it is short call. So what I can do here is I can short 97, which I think the minimum is 100, but that's okay if it's just a 3 XRP difference. Even though when you are doing this with larger amounts of money, not just like 45 bucks that I'm doing here, do it right. Make sure that the amount's the same. Just this time it can't, because I was only able to buy 97 XRP, which is silly. So I'm going to be selling 100 XRP, and it's going to go through, and yeah, and I'll show you guys, and then we're going to look at the risk profile and stuff like that. So it's sold, as you can see right here. And this right here is not the chart of Ripple. This is the chart of historical of this contract right here that I'm now short 100 contracts of. You can see would have been a lot better to buy XRP and short it up here, 27th of January when price was where, like here, yeah, when price was closer to 54, of course, but beggars can't be choosers. So yeah, now I am in this position. You can see that's my available balance, which is negative, but I am long XRP, as you can see right here. So there are two different kinds of margin. There is, if I click on this, there is a multi-currency margin, which is basically where you can use spot assets to margin anything. Or you can use single currency margin where everything would be Tether. I think it's better to probably use MCM, multi-currency margin. Now, as you can see here, I have really, really low risk because this covered call strategy is safe. So how do I run this strategy now that I have done it? So here's what you need to know about a covered call. There are only two outcomes, guys. Either the contract is in the money or it's out of the money. If the call contract is in the money, that means that my short call will be losing me money because I shorted it here. And in the money means that it expires with value. Got it? So if it does that, then what's going to end up happening is I'm going to make money on my long XRP spot position, and I'm going to lose money on my short XRP call position. When this contract expires, I need to then close my XRP. Okay? So let me just write that out at the top. If contract expires, ITM, you need to sell spot, your spot position. Okay? And then that will complete the covered call. Okay? You will basically be left with just a little bit of extra profit. What we typically want to do, with a covered call though, is the second thing. If contract expires OTM or out of the money, that means that the call that I just shorted at a strike price of 0.54 on XRP, on this asset right here, if price does not settle above there on Feb 8, I think that's when this expires, yep, Feb 8, then the contract is expiring out of the money and I get to receive the entire premium. So if that happens, I just keep the XRP. I just keep my spot XRP. And what that would essentially mean is that I would just have more money. I would just have more premium. Now, how much extra money would I have? Easy way to calculate that. We are just going to go to positions. 100 times this is going to be, the total profit I can make. You can also see all the Greeks and stuff right here as well. So if we do 100 times that, 100 times that, this is not paying me a lot, but that would give me about 20 cents. So about 20 cents of profit. Of course, this can be scaled up a lot more. So this is a much safer strategy. As you can see, there's really no chance of me being liquidated, and everything's perfectly hedged with what I've told you before. So there is another thing you can do that is more risky. So of course, we can own spot, or we could be a little bit more risky and also own futures, and then also use that to margin a futures position against a options position. There is another thing you can do called a poor man's covered call. This is risky, but I will show you it. A poor man's covered call is where you are actually buying a far away call. I'm going to show you guys how to do that. So you're buying a far off call, let's say like 25th of April, all right? What you're going to do, guys, is let's say you buy a in the money far off call that has a delta. The delta here is very important. It is right here of, let's say, 80. 80 or higher is typically better. Let's say we buy this one right here, the 37K. You're going to buy that call right there. Oh, it's kind of expensive though. Let's say you do this on Ethereum actually, because I think if you're going to do a poor man's cover call, I think the lower price of Ethereum is probably going to be, more doable. So if we want to go farther out, let's go to the 28th of March. That seems perfect to me. Now we're going to be buying a call and then also shorting more near-term calls. That's how we make money and make premium. And these are actually relatively cheap. So let's say that you have a few $100 and you want to know how to do a poor man's covered call safely. So what you're going to do is we are going to buy that high delta call. So that would be about, I'm looking at the delta right here, guys. That would be a delta probably of, let's do the 2000. Has a very high delta, about 82.5 delta. We buy that call. We pay 447. So we pay 447 for that, all right? After we pay 447, what we're also going to do is we're going to use that call as margin against any short call that we can also enter. And this is what a poor man's cover call is, where I don't have a full Ethereum. I don't have, on this account, I don't have 2.3 K worth of Ethereum. But what I can do is this kind of fun strategy where I don't have to put up anywhere even near the cost and I can still earn premium. So if I do this, let me open up two tabs just to show you how to properly do this kind of strategy. We just bought, let's say that 2,000 for $447, giving us a strike price of $24.47. Because 2,000 plus the premium of $447. At the same time, I'm also going to be shorting. I'm going to be shorting premiums that have a much lower delta that I don't think will be in the money, and that will continue to generate me profit. Okay? So let's say that I do a 16 delta right here, the 2350, that expires in 2 days. So it's expiring over the weekend. I short this delta right here. I short this call right here at 2350, and I make, as you can see right here, the $4. It's a low premium because it's over the weekend. But if I were to do that, then what would end up happening is if price is below 2350, I would just earn the $4. And if price is above 2350, then it depends on how far price has gone above 2350. But then I would be still earning because I'm still long a farther out call. So essentially what the poor man's cover call strategy is, guys, it's where you buy a farther out call. or you can also buy a farther out put. Both can work. And then you are going to, if you did a put, you're going to also short a near-term put. And if you bought a longer-term call, you're going to be shorting a near-term call. That's the way that you can run the strategy. Now, it's better to do not 3 days or 2 days. It might be better to give it some more time. So if I have the 2000 call that I just bought at 447, maybe it would be a little bit better for me to do something like to short the 2350 here that expires in, 6 days. I can make, $24 off this one right here. So if you want to know what profit and loss would that look like, I can do a quick simulation just to let you know. So if you bought the call for 2447, and let's say the price goes, to, what is the current price of Ethereum? Index price is 2300. Let's say price settles at 2350. What would end up happening? Well, you are going to, obviously you're going to gain money from that farther out call that you had bought for 447. That call will probably be worth about, maybe like 480 something. So you're up money on it essentially. And if you short this call and price expires exactly at 2350, then this will go to zero and you would earn the entire premium essentially. So you would be up about $24 from that. And at the same time, you'll be up money from the longer term call. Now let's simulate if price were to go to 2400 and go there. Well, then you shorted this call for 24, but it went to 2400. And, with that would mean that your loss would be $26 because there's a $50 price difference between these two. And you shorted a $24 premium, meaning you would be losing $26. But because you bought the call, right now, you would be up a fair amount of money because you bought the call that's farther out. So basically what a poor man's covered call is it's a longer term bullish strategy where you can make a fair amount of money as long as the coin doesn't absolutely go crazy higher very, very quickly. So the issue with this strategy, really the main issue is if price very violently goes higher, you can lose a little bit of money because the delta of the lower delta call that you shorted might quickly rise in delta, which can then cause some issues. A benefit of it, though, is that if in the short term nothing happens or if the short term price even goes down, you can just keep selling those calls. You can just keep selling poor man's cover calls, these shorter term calls, and then just keep earning premium until the call eventually expires. Again, I actually do think at the end of the day that it's probably better to go farther out than March 28th. Maybe it's go far out as like September. I think this just seems more attractive to me, to be honest. If I was to really employ the strategy with larger capital, I think doing this with like the 1800 strike would be great. I'm going to pay I'm going to pay like 900 for the 1800. But if I have a call that expires in September 2024, I can just keep shorting calls until September 2024 and very likely make money. So that's what a poor man's covered call is. Again, to say it again, long-term call, you buy, and then the short-term, you continue to sell calls until that longer-term call expires. As long as there's not some crazy volatile move to the upside, of course, you'll probably make money. At the same time, you can also margin all of these three products together, spot, futures, and options. My favorite strategy is not the poor man's covered call. It's a little too risky for me. I love this. I really love strategies like this where I can buy spot of any of these coins and then I can just, easily just short a call to do a traditional cover call strategy. So I've given you guys two strategies on a new platform that I really like, CoinCall, where you can use 3 different products, not much KYC at the moment, to trade like this. So if you enjoyed this video, click the link in the description below if you want to check out this website, CoinCall, or if you want to check out my Discord for more trading ideas, whether they're options, futures, or spot trading. We can handle all of them. Happy trading, guys.